Let me tell you a story about retirement. Thomas is 68 years old. He retired 3 years ago, lives in Colorado. He saved $1.3 million in his traditional 401k and IRA. He gets $2,400 a month from Social Security. He's living the retirement dream. Comfortable, relaxed, grateful. Then at age 73, something happens that he didn't see coming. The IRS sends him a letter. It says, "You are required to take a minimum distribution from your retirement accounts this year." His first RMD, $49,000. Mandatory, not optional. The IRS says he must withdraw it whether he needs it or not. Thomas does the math. $49,000 at a 24% tax bracket equals about $11,760 in federal tax. He can handle that. But here's what Thomas doesn't know. That $49,000 RMD counts as provisional income. It pushes his Social Security from 15% taxable to 85% taxable. That's $5,800 in extra taxes he never calculated. That RMD also pushes his modified adjusted gross income above the Medicare threshold. His Part B premium jumps $81.20 a month. That's $973 extra per year. And the kicker? It doesn't hit until 2 years later. Most people never connect the events. And Colorado taxes that RMD at 4.4%. Another $2,156. Add it all up. Federal tax, $7,300. Social Security spike, $5,800. Medicare IRMAA, $973. State tax, $2,156. Total cost of that $49,000 withdrawal, $16,229. A 33% effective tax rate. Thomas thought he was in the 24% bracket. He's actually paying 33. Over 20 years of forced RMDs, that Cascade costs over $300,000. The IRS calls it required minimum distributions. I call it the retirement tax bomb. But here's the part nobody talks about. There are ARE-specific strategies to defuse this bomb. 5 of them. Strategies that can save $50,000 to $300,000 in retirement taxes. In this video, I'm breaking down 7 retirement tax bombs, showing you the exact math on each one, and most importantly, the specific strategies to avoid them. By the end, you'll understand what most CPAs charge $5,000 to explain. Let's go. Quick disclaimer. I'm not a CPA tax attorney or financial advisor. This is educational explanation of 2026 tax law. Tax situations are complex and individual. Consult a qualified tax professional before making major decisions. Welcome back to Faceless Millionaire. If you're 55 or older or planning retirement in the next 5 to 10 years, this video could save you tens of thousands of dollars. Hit subscribe and let's start with the biggest bomb. Tax bomb number 1. The RMD Cascade. This is the biggest, most destructive tax bomb in retirement. Starting at age 73, the IRS requires you to withdraw money from your traditional IRA and 401k every single year. Even if you don't need the money, even if you'd rather leave it growing, it's mandatory. The formula is simple division. Your account balance on December 31st of the prior year divided by the IRS life expectancy factor for your age. At 73, the factor is 26.5. At 75, 24.6. At 80, 20.2. At 85, 16. The factor shrinks. Your forced withdrawal grows. Example, $1 million traditional IRA at age 73. Your RMD is $37,736. You must withdraw it. The IRS does not care if you need it. At 80, that same million forces out $49,500. At 85.60, $2,500. The older you get, the more the IRS forces you to withdraw. Miss your RMD? The penalty is 25% of the amount you should have withdrawn. On a 37.7 RMD, that's a 9.4 penalty. It drops to 10% if you correct it within 2 years. But either way, it's expensive. The RMD doesn't just create income tax, it triggers a cascade. Event number 1. your Social Security becomes massively more taxable. The IRS uses a formula called provisional income to determine how much of your Social Security gets taxed. For married couples below $32,000 in provisional income, 0% of your Social Security is taxed. Between 32 and 44, up to 50% taxable. Above 44,000, up to 85% taxable. And these thresholds haven't been adjusted for inflation since 1983. They were set 43 years ago. More retirees cross them every single year simply because of inflation. Without the RMD, Thomas's provisional income is about $32,400, barely touching the 50% threshold. Social Security tax, minimal. With the RMD at $49,000. New provisional income, $81,400, well above $44,000. SS taxed at 85%. 85% times 28,800 equals 24,480, now taxable. Tax at 22%, 5386. The RMD alone made $24,480 of his Social Security taxable. Cascade event number 2. Medicare IRMAA. IRMAA. Income-related monthly adjustment amount. If your modified adjusted gross income exceeds certain thresholds, your Medicare premiums go up, sometimes dramatically. And here's the trap within the trap. IRMAA uses a 2-year look-back. Your 2026 Medicare premiums are based on your 2024 income. That RMD you take this year won't affect your Medicare bill until 2 years from now. Most people never connect the two events. The 2026 IRMAA tiers for single filers. Under $109,000, you pay the standard $202.90 a month. Cross that line by $1, $284.10. Each tier is a cliff. $1 over, and you pay the full surcharge for that entire bracket. Thomas's Magi this year is about $95,000, just below the $109 threshold. He dodged IRMAA this year. But as his remaining IRA grows and RMDs increase, he will cross that cliff. And when he does, his Medicare jumps $81.20 a month. That's $973 a year per person. For a couple, double it. If Magi crosses $137,000, Part B jumps to $403 a month. That's $2,400 extra a year. For a couple, $4,800, all because of a forced withdrawal you didn't want or need. Cascade Event 3. State income tax. 34 states tax retirement income. Thomas is in Colorado, which taxes at 4.4%. That's another $2,156 on his $49,000 RMD. The complete cascade on one screen. Federal tax, $7,300. Social Security spike, $5,386. Medicare IRMAA, up to $973 this year, in future years. State tax, $2,156. Total, $14,800 to $15,800. Effective rate, 30 to 32% on a $49,000 withdrawal. Thomas thought he was in the 22 to 24% bracket. The reality is 30 to 32. That hidden 8 to 10% comes from Social Security taxation, Medicare premiums, and state tax cascading on top of federal. And this isn't a one-year problem. Over 10 years of mandatory RMDs, the amounts grow every year as the life expectancy factor shrinks. Over 10 years, Thomas takes approximately $580,000 in forced withdrawals. At a 31% effective cascade rate, that's roughly $180,000 in total taxes. Money that strategic planning could have dramatically reduced. But here's the good news. There are 5 specific ways to diffuse this. Fix 1. Roth conversions before age 73. Every dollar you move from traditional to Roth before RMD start is one less dollar the IRS can force you to withdraw. Convert during low-income years, pay 10 to 12% now instead of 30% later. Fix 2. Qualified charitable distributions. If you donate to charity, you can send up to $105,000 a year directly from your IRA to the charity. It counts towards your RMD, but it's completely excluded from your taxable income. It doesn't trigger Social Security taxation. It doesn't affect IRMAA, it's invisible. Fix 3. Manage the IRMAA cliffs to the dollar. Know that the threshold is $109,000 for singles, $218,000 for married. $1 over cost nearly $1,000 a year. Plan your income precisely. Fix 4. Stagger strategically. You can delay your first RMD until April 1st of the following year. But be careful, that means 2 RMDs in 1 calendar year, which can push you into an even higher bracket. Plan the timing. Fix 5. Consider relocating to a no-income tax state. Eliminate the state tax layer entirely. 4 to 13% savings depending on current state. We'll cover this in tax bomb number 4. Tax bomb number 2. The 85% trap on Social Security. Here's how it works. Your Social Security benefits can be 0%, 50%, or 85% taxable. It all depends on one number, your provisional income. For married couples, below $32,000, 0% taxable. Between $32,000 and $44,000, up to 50%. Above $44,000, up to 85%. And here's the problem. The red zone is where most retirees with any meaningful savings end up. If you have a pension IRA distributions investment income or rental income, virtually any income beyond Social Security, your provisional income almost certainly exceeds $44,000. Real scenario. Married couple. $35,000 from Social Security. $30,000 pension. $25,000 from IRA. $8,000 in dividends. Provisional income, $30,000 plus $25,000 plus $8,000 plus $17,500 equals $80,500. Deep in the red zone. 85% of their $35,000 is taxable. At the 22% rate, that's $65,445 in federal tax on money the government gave them as a retirement benefit. And here's the key insight. Roth withdrawals do not count toward provisional income. If they replace that $25,000 IRA distribution with $25,000 from a Roth, their provisional income drops. Their Social Security taxation drops. Savings. Over $800 a year, every year. Now let me show you why the timing of when you claim Social Security matters even more than most people think. Option A, claim at 62. Benefit is reduced 30% to $1,600 a month. $19,200 a year. Smaller checks, but you get them 8 years sooner. Option B, wait until 70. Benefit grows by about 8% per year of delay. At 70, you're collecting $2,816 a month. $33,792 a year. 76% more than claiming at 62. The raw break-even, claiming early, gives you a $153,600 head start over 8 years. Option B catches up at $14,592 per year more. Break even, around age 80. But factor in tax optimization and the break-even shifts dramatically. During years 62 to 70, Option B retirees do Roth conversions at low tax rates. When Social Security kicks in at 70, they have more Roth and less traditional. Their Social Security stays less taxable. The tax-adjusted break-even moves to about age 78. Over a 30-year retirement, Option A nets about $486,000 after taxes. Option B nets $693,000. $207,000 more by waiting. That's the combined power of higher benefits and lower taxation. Tax bomb number 3, the Roth conversion timing mistake, and this one catches people who are trying to do the right thing. Here's the pitch. Convert $100,000 from your traditional to a Roth today. The growth is tax-free forever. What they don't emphasize, the year you convert, you owe income tax on the entire conversion amount. If you convert while you're still working at a high income, that $100,000 stacks on top of your salary. Bad timing. You're 60 still working, earning $180,000. You convert $100,000. Total income, $280,000. 24% bracket. Tax, $24,000. Plus, Medicare IRMAA gets triggered at 65 from the 2-year look-back. Total cost, over $26,000. Good timing. Age 62, just retired. No salary. Convert the same 100,000. After standard deduction, taxable income is about 64,500. Tax, about 7,500 at blended 10 to 12%. No IRMAA triggered. Total cost, 7,500. Same exact conversion. Same $100,000. Different year. $18,900 in savings. Just from timing. The golden rule, convert during the Roth conversion window, ages 62 to 72. You're retired, no salary. You're delaying Social Security, so no benefits, adding income. RMDs haven't started yet. These are the lowest taxable income years of your entire life. This window is finite. Once RMDs and Social Security kick in, it closes. The strategy, convert 50 to 80,000 per year for 8 to 10 years. Stay within the 12% bracket. Over a decade, you move 400 to 800,000 from traditional to Roth. Tax cost, 40 to 80,000 at low rates. But the future savings from reduced RMDs, lower Social Security taxation, and avoided IRMAA, 80 to 200,000 or more. One bonus trap, the pro-rata rule. If you have any traditional IRA balance when doing a backdoor Roth, the pro-rata rule makes your conversion partially taxable. The fix, roll old traditional IRAs into your 401k before converting. We covered this in depth in our Roth withdrawal rules video. Tax bomb number 4, state taxes. The tax bomb most retirees forget until the bill arrives. California, state income tax up to 13.3%, the highest in the nation. Taxes, pensions, 401k withdrawals, IRA distributions, and capital gains. Texas, state income tax, 0 across the board. Pensions, 401k, IRA, Social Security, capital gains, nothing. Same 100,000 in retirement income. California, 24,000 federal plus 9,300 state equals 33,300 total, 33.3%. Texas, 24,000 federal plus 0 state equals 24,000 total, 24%. Difference, 9,300 a year. Over 25 years, 9,300 per year times 25 years equals $232,500. Just from where you live. 9 states have no income tax. Florida and Texas are the most popular retirement destinations for a reason. But moving isn't as simple as changing your address. California's Franchise Tax Board actively audits people who claim to have moved. You need to establish genuine primary residence in the new state. Update every document. Sever significant ties. Get it wrong and California taxes you anyway, plus penalties. Tax bomb number 5, the inherited IRA. And this one isn't about your taxes, it's about your children's taxes. Before the Secure Act, you could stretch an inherited IRA over your entire lifetime. Inherit 500,000 at 45, take small distributions over 40 years. Manageable, tax efficient. After the Secure Act, same 500,000. Must empty within 10 years. No exceptions for most beneficiaries. Average distribution, 50,000 a year. Tax at 24%, 12,000 a year. 4 times the annual tax bill of the old rules. 3 siblings inherit 900,000 equally. Sibling A, salary 60,000, inherited distribution 30,000 per year. Total 90,000. Tax bracket 22%. Annual tax on inheritance 6,600. Sibling B, salary 120. Total 150. Tax 24%. Annual 7,200. Sibling C, salary 180. Total 210. Tax 24 to 32%. Annual 9,600. Same inheritance, wildly different tax bills based on their existing income. The fix for estate planning: if you're leaving a large traditional IRA to your children, consider converting it to Roth before you die. You pay conversion tax now at your presumably lower rate. Your children inherit the Roth and distribute it tax-free over 10 years. They avoid 24 to 32% tax on every dollar. The exception: eligible designated beneficiaries still get the lifetime stretch. Surviving spouses, disabled individuals, minor children until majority, and beneficiaries within 10 years of the deceased's age. Most adult children do not qualify. Tax bomb number 6. And this is the strategy that ties everything together. The withdrawal sequence. Organize your retirement savings into 3 buckets. Taxable. Your brokerage account taxed at preferential capital gains rates. Tax deferred. Your traditional IRA and 401k taxed as ordinary income. And tax-free, your Roth IRA zero tax. Phase 1. Ages 62 to 70. The golden window. Live off your taxable account capital gains at 0 to 15%. Simultaneously do Roth conversions at 10 to 12%. Do not touch your traditional IRA. This is the lowest tax decade of your retirement. Why this works? No salary, no Social Security, yet no RMDs yet. Your provisional income stays below $44,000. When you eventually claim Social Security, it stays minimally taxed. Medicare IRMAA stays at baseline. Everything in the green zone. 8 years of conversions at $60,000 a year. That's $480,000 moved from traditional to Roth. Total conversion tax, about $52,800, but the future benefit, $480 less in RMDs, less Social Security taxation, less IRMAA, saves $80,000 to $150,000 or more over the rest of retirement. Phase 2. Age 70 plus. Claim Social Security at 70 for the maximum benefit. Live primarily off Roth, invisible to the IRS. Supplement with taxable account. Traditional only as forced by RMDs. The Roth shields your Social Security from excessive taxation. Phase 3. Age 73 plus. RMDs are mandatory, but because you converted $480,000 earlier, your traditional balance is smaller. Your RMDs are smaller. The Cascade taxes are smaller. You can't eliminate RMDs entirely, but you can shrink them dramatically. And for charitable retirees, the qualified charitable distribution. Up to $105,000 a year directly from your IRA to charity. Counts toward your RMD. Completely excluded from income. Doesn't trigger Social Security taxation. Doesn't trigger IRMAA. The ultimate RMD hack. The bottom line. Without the withdrawal sequence strategy, your effective rate is 24 to 32%. With it, 12 to 18%. On $100,000 a year, that's $6,000 to $14,000 saved annually. Over 25 years, $150,000 to $350,000. 3 quick hit tax bombs that deserve a quick mention. Bonus 1. Concentrated stock. $500,000 in one company's stock. Selling triggers $60,000 in capital gains tax. The fix. Donate the shares to charity for a full deduction without the capital gains hit. Or sell over multiple years to manage brackets. Bonus 2. The 55 versus 59.5 confusion. The rule of 55 allows penalty-free 401k access if you leave your job at 55 or later, but it does not apply to IRAs. Roll your 401k to an IRA at 55 and then withdraw? 10% penalty. A $10,000 plus mistake. Bonus 3. Overlook credits. Many retirees don't claim the Savers Credit Energy Efficiency Credits or medical deductions above 7.5% of AGI. That's $2,000 to $5,000 left on the table every year. 7 tax bombs. And the combined cost, if you hit all of them, easily $500,000 or more over retirement. But every single one is diffusable with planning. If you're 55 to 62, your action plan starts now. Account for every dollar across every account type. Find forgotten IRAs. Model your tax scenarios. Understand your state's rules. Ages 62 to 72, use the Roth conversion window. Convert $50,000 to $80,000 a year at low rates. Live off taxable. Delay Social Security. Keep provisional income low. This is your lowest tax decade. Use it. Age 73 plus, manage RMDs strategically. Use QCDs. Watch IRMAA cliffs. Lean on Roth. Review every year. By implementing these strategies, your effective tax rate drops from 24 to 32% down to 12 to 18. On $100,000 a year, that's $6,000 to $14,000 saved annually. Over 25 years, $150,000 to $350,000 that stays in your pocket. The person who understands these 7 bombs and plans for them retires tax efficient. The person who doesn't pays 30% on every dollar for the rest of their life. You now understand them. The question is, will you act on it? The retirement tax bomb is real. But you saw it coming. If this video changes your retirement planning, hit subscribe. Next week, I'm breaking down the exact Roth conversion strategy for the 62 to 70 window. See you there. Full disclaimer. This video is for educational and entertainment purposes only. Nothing constitutes tax, financial investment, or legal advice. I am not a CPA, tax attorney, enrolled agent, or financial advisor. Tax situations are complex and individual. The examples shown are for illustration and may not apply to your situation. All tax brackets, Medicare rates, IRMAA thresholds, RMD tables, and Social Security thresholds are based on 2026 law and may change in future years. The ABA senior deduction is temporary through 2028. RMD calculations depend on account type, beneficiary designation, and other factors. The uniform lifetime table shown applies to most account owners, but alternatives exist for spousal beneficiaries. Medicare IRMAA calculations use a 2-year look-back and are adjusted annually. The cliff effect means $1 over a threshold triggers the full surcharge. Amounts shown are 2026 CMS figures. State income tax treatment varies significantly. Some states tax retirement income differently or offer exemptions. Verify your specific state's rules before making relocation decisions. Establishing legal residency requires meeting multiple criteria. The Secure Act inherited IRA provisions are complex with multiple exceptions. The 10-year rule has nuances regarding annual distribution requirements that are still being finalized by the heirs. Consult a CPA for your specific situation. Qualified charitable distributions, Roth conversions, withdrawal sequencing, and other strategies have specific heirs requirements. Do not implement any strategy based solely on this video. Consult a qualified CPA or tax attorney who specializes in retirement tax planning. Individual results will vary. Be smart, plan ahead, and make informed decisions. Thanks for watching.